All right, good afternoon, everybody, and a happy belated Father's Day to all you fathers out there. My name is Ryan Dillon. I'm a financial advisor here at Secured Retirement. Today, we're joined by Anthony Shink with Minneapolis Portfolio Management Group. He's going to be talking today, giving a little presentation, talking about the market, talking about their investments, things of that nature. So very much pleased to have him on board today. With that said, we'll get going here. I'm going to start the presentation. Again, this is your Monday Market Huddle. We're going to be talking about value versus growth investing and market updates. Anthony's pleased to join us here. Thank you so much. Again, disclaimers, this information and these opinions are subject to change without notice. Any type of investing involves risk, including the loss of principal. There are no guarantees. Our firm does not assume liability or loss and result in by any person upon which such information or opinions. Again, here, this is for general information only. This shall not constitute any offers to buy or sell or solicit any securities. You should consult with your financial advisor in the office here should you want to act on anything we say today. So again, we've got Anthony with us now. People that are listening here, just want to inform you guys that today we sent out a presenter link. So people that are presenting, we might see you pop on our screen real quick. I will manage people to try to turn off your cameras, but we did send out accidentally a presenter link. So without further ado, Anthony, why don't you take it away? And thank you, sir, for being here with us today.
Well, Ryan, appreciate the opportunity. It's always a pleasure to work with you and the rest of the team over at Secured Retirement. And today I figured, given all of the recent noise we've been experiencing with rising interest rates, the concern about our Fed increasing interest rates, inflation, as well as the geopolitical events that are happening, it made sense to kind of talk about those things as well as the general markets and try to, I guess, stitch the two together to hopefully give all of us a better picture of what may be happening in the markets, and that the understanding that these things are not new, that this happens throughout history. And the question is, what can we learn from history that'll hopefully give us a better sense of how we should be moving forward as these events hit our globe as well as the general markets themselves. Now, if you take a look at the two main ideas or styles of investing, you have people that believe that there's value investing and growth investing. And really, the big difference of these two are in this chart. Now, we at Minneapolis Portfolio Management Group, or MPMG, are value investors. We are really focusing all of our efforts working to locate great companies who, in our opinion, the stock of those businesses is inefficiently priced compared to the true value of those businesses. So what we try to do is find companies that have low valuations, that there is a margin of safety, that the company itself, if you paid for its buildings, its property, its equipment, its brand, that hopefully that information, that those assets are greater than what its stock price is trading for, the valuations of its stock price are trading for in the open markets. And we also like to find companies that have dividends, that we have some type of cash flow on these businesses. And we really focus on the idea that if we can find these companies that are great businesses at a fair to solid price, over time, our clients in our investment philosophy will reward those that are patient. Versus growth investing, which is really working to find a company that will hopefully do well over time, that its story is exciting, that this company is growing at a significantly faster rate than the market believes that it is. And hopefully you're right. But as a value investor, what we're really working to find is great companies that over time reward patient investors and hopefully give you a few less sleepless nights than growth investing. And throughout the market cycles, both of these kind of go up faster or slow down depending on how the market cycles are behaving. If you believe in Aesop's fable, value investing is more like the tortoise and growth investing is more like the hare. Now, over time, you can see that value investing, trying to find great companies at a reasonable price, has significantly outperformed growth. Now, does that mean it'll continue? We have no idea. However, we believe that history is on our side and that value investing will continue to provide clients a solid return over market cycles. Now, if we take a look on more recent annualized returns, you will see that growth investing, or putting your money in the cocktail hour stocks, as I like to call them, the Teslas, the Amazons, the Facebooks, these are great businesses that have been generating significant earnings. However, the valuations of these companies are extremely high. And over the last 3 to 5 years, these type of investments have been growing at almost double the historical long-term averages of the general market. If you take a look over the last almost 27 years, back to when Minneapolis Portfolio Management Group started, you will see that the S&P 500 had an annualized return year in and year out of just shy of 11%, while value investing has had an annualized return of just over 10% during that same period of time. Now, if you look over the last several years, value investing has pretty much stayed consistent with its annualized returns of around that 10 to 11% versus the growth investing, which has almost doubled or significantly outperformed its historical averages. So if you believe in the law of diminishing returns, it's likely that what we're experiencing now in the markets over the last 6 weeks or so is that these growth companies, you're starting to see their valuations come to more realistic levels. Now, up until the beginning of this year, the last couple of months, growth, this is another chart showing value versus growth, the differences between their strength has been at an all-time high. The growth has significantly outperformed value on a relative basis over the last multiple years. Now, what we have seen happen over the last couple of months, as I was saying, that we've seen a lot of these businesses come back to more fair valuation, is that when you take a look at the Facebooks and the Amazons and NVIDIA's, great companies where they've had a price to sale of nearly 10.5%, you've seen them drop nearly 30% to an average of 7.9%. And even over the last month, those multiples have even compressed significantly more. PEs have gone from 56 down to 38, and they're even more compressed today. Now, as I was saying before, with Minneapolis Portfolio Management Group, we really work diligently to try to take as much investment risk out of the equation as we can. And the reason we do that is so hopefully our clients don't necessarily experience these huge swings in valuations of the investments that we place our clients in. We really work hard to identify companies that are leaders in their industry, that they have a real competitive advantage or something that just can't be replicated by competitors coming into their industry. We really work at understanding management. We want to quantify that investment risk or that make sure that we have that margin of safety for our clients. And like I said, the first thing that we do is try to take as much market risk out of the equation, looking at companies that have low price to sales, price to book, price to cash flow. Once we've located some interesting businesses, we want to understand those business risks. Do they have low to no debt? Do they have solid assets? Are they producing excessive cash flows? And are they leaders in their industry? But if all we did was we look for cheap companies with strong financials, we could end up in owning buggy whip companies or blockbuster videos, businesses that are no longer relevant. So what we try to do is see, is there a catalyst out there? Are these companies not only making those products and services for today, but what about tomorrow? Who's management? Are they incented appropriately? And this business plan that they talk about to fix those problems that may have made these companies cheap in the first place, does it even make sense? And then the last thing we do is look for confirmation, working to see, is there other things going on within the industry? Are insiders buying shares themselves? Indications that maybe we're onto something unique. So when we do this, what we're trying to say is price is everything. We're really working to find great companies whose stock price is inefficient compared to what we believe the true value of this business is over time. Now, if you take a look at the top 10 holdings in our portfolio, FedEx, it's a company that you can't replicate today with the fleet that they have between planes and trucks. It's nearly impossible. It's just cost prohibitive. You've got businesses like Caterpillar and General Motors, great companies that have very unique operating businesses that we believe not only are surviving, they will continue to thrive in the years ahead. Now, if you look at the valuations, when I said that the price to sales of the Facebooks and the Amazons of the world were 10.6, we were buying our companies on average at a price to sales of 2. And over the last month, from April to May, we saw that compressed to about 1.8. And today, the price to sales is roughly 1.7, maybe a little under that. When you look at our PEs, again, the compression has been significantly less, where we have been able to weather the storm. Not saying we didn't get wet, because in these type of environments, everyone gets wet. But hopefully, by paying the right price and being patient, these type of businesses will not only dry out faster, but they will hopefully continue to move forward in the market cycle ahead of us. The type of companies that or areas that we're investing in are businesses like or areas like infrastructure with names like Caterpillar and Siemens and Terex that make the cranes that you often see when you drive by buildings. We're working to have a little exposure to gold as we have inflation concerns. With Newmont Mining, we have Orion Engineered Carbons, which is another commodity-based material that's primarily used in, well, for Orion Engineered Carbons, for tires on many of our automobiles. It is a commodity that they manufacture carbon black. That's in anything really that is black that we see or touch on a daily basis. We continue to believe that big data is going to be important, that 5G technology is continuing to grow. It will become more and more integral in our world ahead. So not only are we making sure that we have companies that we pay the right price for, but also that we're in areas that we feel are continuing to grow over a market cycle or two ahead of us. Now, what's interesting about this type of a portfolio, and as I said before with the valuations, is that when you take a look, when you go through these market bubbles, these cycles that happen, they're natural. It's a cleansing that most of us experience multiple times throughout our investing lifetimes. During the 1960s with the Nifty 50, it took the Dow almost 17 years to break even with the 50 greatest companies where you could just set it and forget it. During the dot-com years, that many of us may have started investing or were just early in our investing years. That took almost 13 years for the S&P to get back to even during the dot-coms. And if the NASDAQ, with all of its high-flying tech companies, also took almost 14 years to break even during the dot-com period. MPMG, with our value focus, it took us just over 2 years when we experienced our worst loss during the financial crisis of 2008 and 9. We got hit like everyone else during the storm, as many of our companies are feeling today. However, it took us just under 2 years for our clients to break even, and that allowed us and our investors to have that much more assets working for us as we recovered. Now, if you take a look from the peak to the trough of the financial or of the dot-com years, during that period, the S&P and the Dow and the Russell all experienced significant drawdowns during that period. We also got wet during that time, as you can see with this chart, or I should say spreadsheet. However, over that 3-year period of time, with patience, our clients had an average annual return of about 2 2/3%, whereas the S&P and the Dow and the Russell were still negative and took them time to recover and move back from, or get back to even. As I was saying before at the beginning of this experience, or this discussion, the stock market's resilient. Investors have experienced many challenges over the years. If you look at all of the incursions that have happened from Germany invading France or Germany invading Poland to the Iraqi war and 9/11, as well as most recently Russia invading Crimea and now Russia invading Ukraine, on average, the market has been up 80% of the time, well, actually 77% of the time, 1 year after that event. Now, if we take a look at market recessions during the same picture, you will see that nearly 65% of the time when a recession hits, the market bottoms out within under a year, really with under 6 months, many of the times, before we start to see some positive activity. So as painful as we experience with these drawdowns, and nobody likes them, hopefully over time, you have the opportunity to continue to invest, having dividends, gain speed, and within a year or so, you're in a much better footing as the market starts to turn around. And that's part of the reason when you look at value investing is that value type of investors have had the fortunate history that they haven't dropped down as much or have not lasted down as long, and they've been able to recover significantly faster. That has allowed them to continue to produce wealth for clients over time. And in the case of Minneapolis Portfolio Management Group, or MPMG, we've been very fortunate to have an annualized return of about 11.8% net to our clients versus the S&P 500 at about just over 11%. And this market, it is a great opportunity to continue to dollar cost average in and to be patient, and you will be rewarded. Ryan, do we have any questions? Or do you have any questions that I could answer?
Yeah, Anthony, thank you so much. Reminder to everybody, feel free to go to the chat room here and type in some quick questions if we do have a couple of minutes left here. But yeah, Anthony, real quick, I appreciate your time today and great information as always, and we value your partnership as well. You know, you talked about buying, low, PE ratios, being patient. I know with COVID here the last year, it's been a little bit different, right? With your history of buying and selling, but for the most part, MPMG, long-term horizons. What's your philosophy when you make a decision to buy a stock, and how long are we typically holding this and things of that nature?
Well, thanks for the question, Ryan. Typically, when we search to find great companies, we're really investing in these ugly ducklings, and hopefully over time that they will turn into these beautiful swans that'll fly off, and we can find the next unique opportunity. What we're looking for are these companies that we can hold on to for the next 4 to 6 years, 3 to 5 years, because we know it's going to take time for them to fix those problems that made them cheap in the first place. And then for us to be rewarded for being patient while they've gone through that transition. Now, during COVID, we had the great opportunity to invest in some fabulous names at unrealistically low prices. One that comes to mind is Starbucks. Great business. And we had timed it almost perfectly, that within just over a year, our clients had doubled their money. And usually we expect that to take 3, 4, 5, 6 years to happen. It happened just over a year. So we said, geez, thank you for that opportunity. Let's close out that position and find the next unique name. Okay. And we continue to do that over and over again. Most recently, we have made a couple of trims in our names, in our portfolio. Companies like Borg Warner, BWA, great business. Their claim to fame is really the turbocharger, if I remember properly.
Okay.
And given the current environment, we felt that here's an opportunity to trim some of that name and put it in General Motors, which we think will, if you'll excuse the pun, be a faster horse to put our money in, that over the next few years will really benefit our clients.
All right. Sounds good. We got one question here that says, can we enlarge this page? Unfortunately, I think we're kind of locked in our viewing here, so I apologize. Feel free to reach out to our office here if you want to discuss any of these slides or see anything in a better view. One other question here, Anthony, is the issue of stagflation, and what are the people in your office saying, or do you see that coming down the road?
It is a concern. We're definitely watching it. Do we see stagflation happening? Not at this point. We just do not see it. However, when you take a look at what our government has been doing in trying to hopefully get our interest rates, or I should say interest rates up, we can squash inflation before it really becomes a problem. And we continue to see the real symptoms of stagflation. At this point, it's still a little early to tell, in our opinion.
Yeah, no, agreed. I think that does it with our questions today. We'll let everybody go. Anthony, again, thank you so much for your partnership and time, and really value what you provided us today. Like always, anybody on the call here that if you want to discuss these items more in depth, the market, if you'd like to review your retirement plan, again, just make sure we're doing everything possible to battle these times, the inflation numbers and the market numbers. We're happy to get you in here and meet. So feel free to call our office. Anthony, with that said, we'll sign off for today, and thank you very much, sir.
Appreciate it. Thank you again, and hope everyone has a wonderful, safe summer.
All right. Bye now, everybody. Thank you.